Welcome to Real Estate 360 with your host, real estate expert. He's an author. He is a speaker. He's a podcaster, a YouTube star, HGTV star, and a friend of mine.
Sandy.
Mr. Kenn Renner.
Hey, my favorite radio host.
Hey, thank you very much. It's nice of you to say. I think we should get right to it and talk about what everyone's thinking and talking about. And that's what's going on in the stock market and how it affects interest rates and the economy as a whole.
Absolutely. So we're talking about this is the first week in March 2020. And, this is when we've seen the most dramatic stock market swings we've really ever seen. And it's all due to bad news. Fear of the market is what drives interest rates. And just drives the stock market up and down. Uncertainty. Yeah. Yes. So, going back to the whole coronavirus thing that's everybody's talking about, and it's in the news, and the news feeds on the fear, and the fear feeds on the news, and then stock markets go crazy. And it's a fear versus greed. They have actually a index for that, which is the
of course they do.
The fear greed index. Yeah, it's the volatility index, and it's at the highest it's been. So we've seen that. And so what's happened though is that because of the uncertainty in the market, it's actually really, really good for real estate, and it's really, really good for interest rates. Mm-hmm. And anytime the interest rates are going down, that's going to increases buying power and also increases cash flow for our investors. So, with the Fed taking a 0.5, 50 basis points drop in the federal funds rate, that's unheard of since 2008. Yeah. And so obviously an emergency cut, almost a panic cut, and that didn't really help the market because it showed that even the government was concerned about the economy and things like that. So right now, that's actually really the silver lining of all this is that it's really, really good for interest rates.
Can I ask you a quick question? You said concern. Was it concern or preventative measure? Do you know what I mean? By they were like, let's do this now so we're not really hurting later. Any take on that?
Well, they were planning on, they had already announced that they were going to be doing some rate cuts. And in mid-March, it was going to come up that they're probably going to do,
they just did a little earlier.
They're going to do a quarter. Okay. That was what everybody expected. So when they did a half, for the first time also in a long time outside of a meeting, your usual meeting, that was a dramatic, it helps. It's going to help interest rates, but it's also, I think it drove a little more panic into the market.
Okay.
Because it showed that even the feds are uncertain with what's going on with the whole thing.
Right.
So, once again, that drove, when the money comes out of the stock market, when people liquidate, they want to put it into safe havens. And so there's only a few places you can put safe havens. One of them's gold. Okay. Another place they put in is treasury bonds. So the treasury bonds, the 30-year and the 10-year treasury bond, that's what measures our mortgage rates, because those bonds compete against the mortgage-backed securities. And so that you can really pretty much, here's a clue for you about the mortgage that we're talking about, the mortgage rates. You can follow what's going to happen to the interest rates by following what the 10-year bond yields are doing. So as money's being poured out of the stock market into the treasuries, that makes their yields go down and the prices of those bonds go up because the more of the demand. Another place that people put their money when they're rolling out is hard assets, and real estate is a hard asset. So there's kind of a dichotomy here. It's actually a really good opportunity because what happens a lot of times, especially I do a lot of investors, work with a lot of investors around the nation and even international investors, and what they have a tendency, especially the newbies, will put everything on hold. Fear, everything, stock market crash. I'm going to stay put. I'm not moving. And here we are looking at it going, oh my, the rates are the lowest they've ever been. It means I'll never get the cheapest money I've ever going to be able to get in the history of mortgages.
Right.
And also, as everybody else is staying on the sideline, I'm able to go, and my clients are able to go and snap up properties that other people are hesitating on. So that's kind of really the whole fear greed thing that's going on in the stock market. I've been predicting this for a long time that there was going to have to be an adjustment, because whenever they say, like we had in our previous podcast, any market that we talk about that says it's crazy. We've been
right. I remember you saying about that.
Yeah,
paper.
Watch out when they say, if it says it's crazy, because that means that that market is overheated. And so, and even they've talked about Austin being crazy, but I'm telling you, the Bay Area real estate is crazy. I mean,
crazy.
I mean, 900 is the median for the area, 900K for a house, but in the Silicon Valley, it's more like 1.2, 1.5, and really there's no place for people to go. In other words, it's bound by the mountains and bound by the ocean. So a lot of our clients are coming out of the Silicon Valley, and whether they're buying a primary residence or most of my clients right now are buying investment properties, because our average investment property is $200,000 to $250,000, and median price now is $308,000. So we stay below the median, and we also do a lot of new construction. So that and people like the new construction. Not only do the owners like it because they get a brand new house with warranties and everything's covered, but they also get the tenants like it. They like new construction too. That's like renting a brand new car, right? So they like it, and the property managers like it because they don't have anything to do because the whole property's under warranty. So it's worked really good. In 10 years, you'll have a 10-year-old house, as opposed to some of the houses that were like around here in this area where they're all 30 and 40 years old. In 10 years, you're going to have a 50-year-old house.
Right.
So, and the other good news is that, people are pulling their money out of overpriced real estate, or if they're smart, and they're putting it, where are they looking for? They're looking for where's the best market in the nation. Austin, Texas, hottest job market in the nation, second year running, as according to Wall Street Journal. Jobs drive real estate. Drives real estate values. It drives our investments. We have 151 people net a day moving here, and people just need a place to live. Hence, we're the landlord. Here's a rental, and so prices are going up faster than our rents, though. So that's a whole nother story. Number one best place to live in America, third year in a row from U.S. News and World Report. And so that's a big deal. And then number one best place to invest, according to Forbes. So people start looking at that, and guess what? They're looking for someone to help them with that, and that's why I raise my hand. So I do these podcasts. That's why we do well over 100 homes a year, and mostly to investors, and a lot of them local, but a lot of them from out of state and even from other countries. Seems to be the Far East is very, very interested in Austin, Texas, and real estate in general. So
is that right?
Yeah, is that
new?
Well, I've been going out to the California market because that's where I'm from since the early 2000s. And I don't think they were the foreigners were as interested in our in real estate and our real estate nearly as much as they are now. So right now, they're just going, this makes sense, and now with the rates dropping, it's incredible. And so what we're having is we have a shortage. We have a housing shortage, and we have a property shortage. So in new construction, a lot of the builders, number one, will cut off investors. No, we're not selling to investors at all. Number two, they're already sold out, period. In other words, they've got to shut down their sales because they can't build them fast enough, which drives up the length of time building them, which drives up costs. So we're seeing actual subdivisions being, no sales going on until we catch up. Wow. And so it's it's a balancing act, being able to find the right sweet spot for us. In investor world, it's about 200 to 250,000. And new construction, that's really hard to find, but that's what we're experts at doing. And we've built relationships with the builders that they'll come to us first. Right. So we're on like waiting lists. So as soon as they open up the new section, they'll call us first, and we've already got them the allotment sold, because they usually only allow up 10% of the subdivision to be sold to investors. Okay. So, but let's get to the interest rates really quick, because this is pretty exciting news. So the rates dropped almost 2 percentage points from their peak about November of 2 years ago. They were about 5.25%, 5.5%. Now we're down to the low threes, and we might be even entering into the high twos coming up. And that's incredible. And so to put it in perspective, I did our median home price is $320,000. So I'm using a $300,000 owner occupied purchase, right? So a couple years ago, when the rates were at 5.5%, you'll be looking at a principal and interest payment of $1,703.
And this is with how much down? I'm sorry.
This is a minimum down. Okay. So three to FHA 3 or 5%, right? And so right now at 3.25%, that payment would be $1,305. So $1,703 to $1,305. That's literally 25% less in principal and interest payments.
Wow.
That's almost nearly $400 less a month every month for the next 30 years. So that's like a 25% less just by so it increases the buying power substantially.
Yeah.
Of course, putting more pressure on our markets, in a higher price point where like what I'm looking for is about a $500,000 loan, which is nearing the conventional limit. You're looking at $500,000 principal interest right now would be $2,176. 2 years ago, it would have been $2,838. So that's literally $662 a month less than it would have been just 2 years ago.
Incredible.
Yeah. So refinancing is going through the roof. People are refinancing, and I highly encourage those that have rental properties or the primary residences to look at refinancing. And we've got, this is in a real estate mortgage office, right?
Yeah.
Benchmark Mortgage, and I've got other companies, and they're all competing for the business. We're going to talk a little bit about that, but let's talk about the rental property, the non-owner properties, which is what I do a lot of. And so our average sales price around $230,000 to $250,000. People are putting $50,000 down, which is 25% or thereabouts, borrowing about $200,000. That current principal interest payment would be about $926. Not bad.
No,
right? Yeah. So the 2 years ago would be 5.75, would have been 1167.
The money's, you said it before we went on the air that, the money's almost free, and it almost, and you would know better than I, when it would come to a mortgage, why would you pay cash if you could when you can get the money so cheap?
Well, don't forget also, this is tax deductible.
Right.
So, I mean, depending on your tax bracket and all those other things, check with your CPA, please. But, but that's the whole thing is that it's tax deductible on top of the cheapest money you can borrow, really.
Right.
I mean, so it's tax deductible, and that change. And a rental property, it is also tax deductible as well. But in this case, a $200,000 mortgage opposed to last year or 2 years ago, from $1,167 to $926, that's $241 a month more in cash flow that our investors would be getting over what I purchased a couple properties 2 years ago.
Because they're not going to change the rent.
Oh, no, and the rent, yeah. So I mean, that's almost $250 a month. That makes a lot of difference,
Sure.
And that's where all of a sudden we also see people, our pro formas are looking so much really amazing, being that we could get a rental property for 3.75%. And I'm not calculating APRs, nationally you're supposed to, by RESPA, I'm supposed to give you APRs and all this other stuff, but I'm just doing this as examples so I don't get in trouble with the RESPA cops. So.
And they're out there listening.
Yeah, so I want to talk a little bit about the builders lenders, because that's what the topic of conversation has been every day with a huge amount of investors that are buying these new construction properties. I want to address this because I want them to listen to this podcast rather than me have to be the broken record for everybody that comes to me. Here's what happens. When you go to a new construction builder, whether you're buying your primary residence or you're buying a rental property, the builder wants to keep the continuity of the transaction with their, quote, preferred lender. And there's usually a business relationship, or they own the mortgage company outright. And there's a good reason for that. That way, the builder can make one call, one place for all the mortgages. Sure. And for that, they, legally, they cannot force you to use their mortgage lender. Legally, right. It's against the law. But they can incentivize you to use the builder's lender. And so we've seen incentives anywhere from a couple percent, like 2 points or 3 points, on up over $10,000, $12,000 if you use our preferred lender. Gotcha. And so what happens, though, is that creates a captive audience for the builder's lender. So the builder, all the people getting their mortgages, whether it be investor or primary, are going to shop with that builder's lender because they're going to get this $10,000 in incentives. And if you don't use them and go to another mortgage company, you lose that $10,000 or 2 points or whatever it is. Mm-hmm. And so they've got that captive audience. So the builder's lender gets loan after loan after loan. The problem is their service isn't all that great. Okay, because they don't have to work for it; it just comes in the door, right. And so they get bogged down because that's right now we're in a mortgage boom, a refinance boom, and so they get bogged down as well. So that's a problem, but we address it because I don't put up with them giving us bad service, especially when I'm bringing a dozen loans to a mortgage company all at once, which happens. And so
what you're going to do with Benchmark.
Yeah, absolutely. And that's the whole thing, is that depending on what the incentives are. So we just talked about those 15 duplex style homes I just sold. Well, they this builder won't pay points or any, because the price is so low. They'll only pay the title policy, which might be $1,200. Well, somebody like Benchmark can undercut that because they could be more competitive than the builder's lender. So once again, the builder's lender, and just to say this, is they're going to charge about maybe 1% in costs more than your average Benchmark or cross country mortgage or whatever.
Right.
So they're gonna charge it because they're going to give you 2 points or $10,000. And I get this call almost every day saying, why is the builder charging me this? And I can get this mortgage over here from Chase or Benchmark for this, okay, this lower rate. And I have to explain to them that, by the way, you are getting this incentive, and you'll have to be able to do it, to get that incentive, you'll have to go ahead and apply with the builder's lender. Now, so there is going to be always, very rarely are they going to actually meet the actual market. But if they get close, like I say with my clients, if they get close, then we're good. If it's out of line, like they're charging 2% more or charging 0.5%, which I've seen recently, 0.5% out of the market, this builder's lender. Being a former mortgage company owner, I know how all this works. And they can't rip off our clients because they have this captive audience. It's a shell game. They make money on the mortgage, but they're giving money to make that happen, right?
Right.
So we can't. I won't allow it to happen. So what I'll do is I'll get to the loan officer, then I'll go to his boss, then I'll go to the boss's boss if I needed to. And so I work my way up the corporate ladder in the mortgage company. And I just want them to get in line. They don't have to match University Federal Credit Union or Benchmark's low rates, but they do have to get close, because otherwise I feel like, wait, we're bringing all this business to this builder. They're giving you all these loans, and now you're spiking them on the other side.
Right.
You're ripping them off.
Right.
And so if it doesn't work when I get to corporate level of the mortgage company, I will go to the builder and say, we're bringing you all of these clients, and you're taking them over here, and they're charging too high. You've got to get it in line, or I'll take my investors somewhere else.
Right.
So
you can do that when you've got a lot of investors and buyers. You can do that.
Exactly right. So this is the problem with only being one buyer buying one house in a lifetime from this builder. They don't have much leverage.
Yeah.
That's why you want a really good real estate broker like me. Yeah. But you want to have somebody that knows the back end. Most real estate brokers really don't, or agents, realtors, they don't really know the lending side like I do, since I was in it for 15 years. But I do. And so I want to make sure that I'll get the builder to at least get in line with the market, and so that's one of the values that you have with a good, experienced, long-term broker, a realtor that knows how the mortgages work. Otherwise, they'll just say, well, just take what you can get, and you remember you're going to be paying this mortgage for potentially 30 years. And I tell these mortgage loan officers sometime, I go, you're charging 0.25% higher, and that's about $8,000 over the next 5 years. But over 30 years, it's a lot.
Yeah.
And you won't even be in the business while this guy's still paying on that mortgage.
Right.
So, that's kind of thing. I get a real pet peeve on it, and
I can see you're passionate about this. Yeah, I can feel it.
As I was, we're talking to Dave McMillan here. I used to own a mortgage company. I used to have to compete with the builder's lender all the time to try to get the business, not getting the incentive, and then sometimes taking a much lesser fee to be able to make it happen. So that's really the reason I'm doing this podcast. Not only update my clients on the market, but also tell them, by the way, you're going to get a little bit higher rate when you deal with the builder's lender. And I can't really change it. I can fight for you, but I can't make them lower their rates.
Right.
When the mortgage crisis was pretty much had fleshed itself out, pretty much the mortgage rates were pretty homogenized at that point. All the brokers were gone. The mortgage brokers, it's all bankers now. They're pretty much out. And so you really couldn't shop for a rate and get much difference. And now, but believe it or not, there is a difference between different companies, and it could be as much as 0.25% interest rate. So that's why you can't always, you don't want to use a no-name lender or an internet lender. You want to use somebody you can actually get in front of and actually have a communication with. That's not an 800 number like some of these national,
or an app.
Yeah.
Right.
Yeah. Rocket Mortgage or whatever,
Right.
So it's really important to have that relationship. And it's also important to have the relationship where somebody's like me bringing $10 million worth of loans to this loan officer this year. I have a lot of clout with them, and I use it as leverage.
Sure.
So it's that relationship that we build. It's all about relationships. And we'll get into more mortgage stuff on the next podcast because I think it's really important. It's the key to home ownership, and it's the key to getting a really good investment.
That's a lot of information, really good information.
Appreciate
and if someone's watching this and they want to get a hold of you, then go to your website, they can give you a call.
Yeah, Kenn, Kenn at buyaustin.com. Or my phone number, text me, 512-423-5626.
Let Kenn use that leverage to help you out.
Absolutely. Give me a call.